Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial world's wildest tales. And today we are diving deep into the Hartford Insurance Group Inc.'s annual report. And let me tell you, this filing is packed with numbers that tell a story of resilience and perhaps a few bumps in the road before we jump into the juicy financy. Our details make sure you are subscribed so you don't miss out on our insights and join our Discord community, linked in the description below to chat more about these filings. Alright, so the Hartford is giving us the full rundown for their 2025 fiscal year ending the 31st of December, and they are a well-known seasoned issuer, meaning they are a big player that the CC knows well. They are showing us their annual report on Form 10K. Now let's get to what everyone really cares about, the financials. First up, the big picture consolidated results of operations for the past 3 years, 2025 compared to 2024, shows a healthy increase in net income available to common stockholders. It jumped up by $725 million, or a solid 23%. This is good news for shareholders because it means more profit is flowing down to them. What's driving this gain? Well, they are shouting out a higher property and casualty underwriting gain of $623 million before taxes, thanks to more earned premiums in property and casualty businesses like business insurance, which saw a 9% bump, and personal insurance up 8%. That plus better prior year reserve development and a lower underlying loss ratio in personal insurance, particularly auto and homeowners, helped pad the profits, but it is not all sunshine. Their business insurance did see a higher underlying loss ratio, which means claims are costing them a bit more. Then there is net investment income. It is up by $343 million, or 13%. This is a big deal for insurers who make a chunk of their money by investing the premiums they collect. They're putting it down to more invested assets, higher income from limited partnerships and other alternative investments, and fortunately reinvesting at higher interest rates. The flip side is a lower yield on floating rate securities, a common issue when interest rate environments shift. But here is a potential red flag. Net realized losses increased by $39 million, driven by lower appreciation in equity securities and losses on foreign currency revaluation. It seems the market was a bit more unpredictable than they hoped. Let's zoom into the nitty-gritty of their insurance operations. The actual cost of claims, known as losses and loss adjustment expenses, increased by $364 million. This is a 2% increase, which sounds small, but it is important to remember that means more money is going out the door to pay claims. The main culprit here is a rise in the property and casualty segment, which saw a $355 million increase. What is behind this? Well, a higher underlying loss ratio in business insurance, as we mentioned before, but also current year catastrophe losses are a factor. They had tornado, wind, and hail events, and a significant loss of $305 million from a California wildfire event in January, which definitely hurt. However, they did see some good news with a favorable change in prior accident year reserve development, meaning they had to dip into fewer old reserves than expected, a net favorable development of $304 million overall in PYC. This is like finding extra money in an old coat pocket. It's a significant chunk of money. That means their old estimates for claims were a bit too high. Now for employee benefits, things are a bit more stable. Premiums are up slightly, but net income is down by 1%. This is mainly due to a higher expense ratio, including higher staffing and technology costs, plus a higher long-term disability loss ratio. That last part means it's costing them more to cover long-term disabilities. This is a common challenge in the insurance world, as costs and claim durations can fluctuate unpredictably. Let's talk about Hartford Funds. Their asset management arm, assets under management, or AUM, jumped by 10% to a massive $154 billion. This is great news because their revenue is tied to these asset values. More assets mean more fees. They saw growth in both mutual funds and ETFs. The big driver here was a change in market value, likely due to rise in equity markets, but they did see a slight net outflow of money, meaning more people pulled money out than put in over the year. It is a mixed bag, but the overall growth in IOM is positive. Now for the investment portfolio as of the 31st of December, 2025, it is a huge chunk of their business, totaling $63.9 billion. The biggest piece by far are these fixed maturities available for sale, making up 72% of their portfolio. The fair value here is about $46 billion. It is good to see a healthy amount in these relatively safe investments, though they did increase their holdings in limited partnerships and other alternatives investments by about 9% of the total, which can carry more risk. The Hartford is operating with strong capital buffers. Their US insurance companies have risk base capital ratios well above the minimums required by regulators. This means they are in a good position to handle unexpected claims or market downturns. Their ratings are also looking good. AM Best upgraded their senior debt rating to A, and Standard & Poor's has raised their ratings across the board, including to A. For core subsidiaries, this is a big signal of financial health and confidence from the rating agencies. Looking at the balance sheet as of the 31st of December, 2025, the Hartford has total assets of about $86 billion and total liabilities of around $67 billion. That leaves them with stockholders' equity of almost $19 billion. It is important to note that their common stockholders' equity, excluding accumulated other comprehensive income or loss, is around $20.7 billion. Which is a positive sign of underlying business health, but that accumulated other comprehensive income or loss figure is negative at over $2 billion. That usually reflects unrealized losses on their investments, primarily due to market fluctuations like interest rate changes. Now to the juicy part: unpaid losses and loss adjustment expenses. This is the money they have set aside to pay future claims for property and casualty insurance. They've got over $46 billion in gross unpaid losses, which is a significant number. It is good that they are managing this well with reinsurance and a substantial net reserve of over $31 billion. However, the asbestos and environmental reserves are still a point of concern, with a $165 million increase in 2025 due to higher claims frequency and settlement rates. This is a classic insurance industry challenge: long-tail liabilities that are hard to predict. Looking at the roll forward for property and casualty insurance product liabilities, we see the movement in their reserves for 2025, their net unpaid losses, and lay out about $31.4 billion. The provision for unpaid losses for the current accident year was over $10.9 billion. But they also had favorable prior accident year development, sign that they are managing past claims effectively. The Hartford seems to be taking cybersecurity seriously. They've got a defense in depth strategy aligning with NIST standards, and they are always monitoring and enhancing their framework. It is a constant battle in today's world, and they explicitly state that no cybersecurity threats have materially affected them, which is reassuring. They highlight the governance structure with reports to the board and a dedicated executive council. Still, this is crucial given all the data they handle. So what is the verdict on the Hartford? Well, they are a financial giant with a strong and improving profit engine driven by PCIC underwriting and solid investment income. Their diversification across insurance and asset management seems to be paying off, particularly their partnership with ARP continues to be a key strength. However, the PCIC business, especially business insurance, shows some pressure from rising claim costs, and persistent catastrophe losses are a constant worry. Plus, those asbestos and environmental reserves continue to be a murky area, though progress is being made with reinsurance. On the flip side, their investment portfolio is largely in high quality fixed income, and despite market volatility, their capital position and ratings are strong, indicating good risk management. The push into AI and digital capabilities looks strategic for future competition. Overall, the Hartford appears to be navigating a challenging landscape with resilience and strategic foresight. Alright, that is our deep dive into the Hartford's latest filing. What do you think about their performance? Leave your thoughts in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more corporate decoded insights. And don't forget to join the Discord community linked in the description to keep the conversation going. Thanks for watching, and we will see you in the next one.